Welcome to our latest podcast. My name is Elizaveta Gridneva, and today we have Erik Norland, who is CME Group economist, joining me today. Hi, Erik.
Hi, thank you so much for having me.
We are very excited to have you. Let's start today's discussion with China, where equity market have recovered lately. What are your expectations for Chinese economy and Chinese stock market in 2026? And what are some noticeable changes in China's export strategy caused by Trump's tariffs?
Well, the Chinese equity market, despite the fact that it's rallied in many ways, still looks like a bargain. The valuation ratios on Chinese stocks are a lot lower than they are in the United States. So there's some very interesting investment opportunities. On the other hand, the Chinese stock market, I think it's fascinating. As you say, it's recovered, but it's trading at about the same level today on some of the big indices like the CSI 300 as it was trading in July 2007. So for 18 and a half years, the stock market there has largely gone sideways while the US market has gone up. But I think that means, maybe there's some incredible bargains among these Chinese stocks that could potentially allow the market to go higher, although it's always very hard to say. With the Chinese economy has been growing very slowly, really since 2022. So they've had basically three and a half, 4 years now of very slow growth by Chinese standards. The Chinese economy is still growing faster than most economies around the world, but the Chinese government releases enormous amounts of economic data. What those data show is that it has some areas of strength. Industrial production and exports are very strong, but it has a lot of areas of softness, including very soft consumer spending numbers, and very soft numbers in terms of things like electrical consumption, rail freight volumes. And the sector that's doing the worst is probably the construction sector. Construction activity in China, which was a major portion of their economy during the 2010s, was falling at around 15 to 20% year on year. And also home prices are falling, which is a problem for a lot of Chinese households, since the average Chinese household has about 68% of their net worth in their primary residence. And so that's kind of what's causing the weak consumer spending. But the outlook for China is starting to change. Pei Lifeng, the Chinese vice premier, spoke at Davos this last week, and he indicated that the Chinese government is thinking about taking actions that will boost consumer spending. If they do that, if it works, we could have a very optimistic scenario for the Chinese economy, but we'll have to wait to see what they do and how effective those measures are.
Let's wait and see. And moving over to Japan. So Japan recently went through elections. The new leader, Takaichi Sanae, already called snap election for early February to secure even stronger position for LDP. She is supportive of expansionary fiscal policy. She's also expected to cut food consumption tax. Market reaction to her plans were mixed. And although equity market rallied, a drop in long-dated government bonds showed that there are some concerns over fiscal spending as well. What is your view on Japanese economic and political situation in 2026? Do you have concerns over fiscal spending and yen stability?
Well, I think the market definitely has concerns about fiscal stability and yen stability. The yen's fallen in half versus the US dollar since 2012. So, back in 2012, $1 bought 80 yen. Now it buys around 155 yen. And the yen has been recovering in the last few days versus the dollar, but that's mainly because the dollar's been falling versus just about every currency. So the yen hasn't really recovered very much versus, say, the euro or the Brazilian real or the Mexican peso, et cetera. And so the concern here is that Japan has an enormous level of public sector debt. There's a lot of concern about debt in Europe and the United States as well. But in Europe and the United States, the government debt is around 100% of GDP. In Japan, it's around 200% of GDP. It's twice as high. And for many years, Japan had interest rates near zero, even slightly negative at the short end curve. So it didn't really matter if they had a lot of debt. But now the bond market there has had a very steep sell-off. You've seen 30-year yields go from about 0.5% all the way up to 3.5%, even close to 4% in recent weeks. 10-year yields are soaring past 2%. And so the cost of financing this debt is beginning to rise. And that's making the market worried about a sort of downward spiral where bond yields rise, which increases the cost of financing the debt, which means a bigger deficit, which in turn means more debt issuance, which means potentially higher interest rates. And then you add to that the stimulus package that the new prime minister has proposed, roughly 2.8% of GDP. It expands the deficit and will add even more debt to the market. So on the one hand, that fiscal stimulus could create faster growth. On the other hand, it could create a lot of concern about the stability of Japanese finances.
Got it. Great overview. Thank you. And now moving to precious metals. So we are all witnessing historic rally for metals over the last few months. I'm sure many investors are struggling to understand the exact drivers behind it and also its implications to a real economy. Can you tell us what do you see as major forces behind this move? And also, do you think we're at risk of another inflation wave caused by a rally in commodities?
Well, that's a great question. So I think that there are basically 5 forces that are driving this. And the first one we've already talked a little bit about, which is deficits. So Japan is running a huge budget deficit. So is China. China has a deficit of 8.5% of GDP, which is enormous. Over the last several years, Chinese tax revenues have dropped from 29% to 21% of GDP. The United States is running an enormous budget deficit of 6% of GDP, and the administration in Washington just announced they wanted to increase defense spending by $500 billion per year, which would likely add another 1.5% of GDP to that deficit, taking it towards 7%. The Germans, who had been very fiscally responsible and very fiscally tight until recently, have announced a 1 trillion euro investment program in their economy. That's about 20% of GDP of spending. The Canadians are doing 140 billion Canadian dollars worth of defense spending to build up their military. Lots of other European countries are also adding to their military budgets. And so around the world, you have these gigantic budget deficits. In addition to that, secondly, you have inflation running above target in almost every major economy outside of China and Switzerland. Third, despite the fact that inflation is running above target, you have almost every central bank cutting interest rates. Fourth, you have this concern about the independence of central banks around the world and whether they're being asked to finance these public deficits. And then lastly, you have geopolitical uncertainty. And so all of these things are contributing to an environment in which people would rather own gold, silver, platinum, and palladium than because central banks can't print them. They would rather own those items than currencies that central banks can create.
Great. And just a question, Erik, is the rally in silver surprise you more than rally in gold?
Well, not really, no. So, since the beginning of last year, gold prices are up 110%. Silver prices are up close to 300% since the beginning of last year. So silver is rallying for numerous reasons. So first of all, it tends to move in the same direction and by a larger amount than gold. That's partly because imagine that you live in a country where it's, say, traditional to give gold as a gift at weddings. Well, now that gold's at $5,500 an ounce, you might not be able to afford it. But even with the rise of silver prices, it's still 1/47th the price of gold. So in other words, 1 ounce of gold can buy 47 ounces of silver. So you could still afford to buy silver. Secondly, China's placed some export restrictions or export licensing requirements on silver, which is boosting the price. And then on top of that, we also have technological change. Silver is being used in solar panels and in batteries. And so it's finding a lot of new uses that are in boosting its industrial sales.
Understood. Thank you, Erik, for joining me. If you enjoyed today's episode, please subscribe to our channel wherever you download your podcast from.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. There is a substantial risk of loss in foreign exchange trading. The settlement date of foreign exchange trades can vary due to time zone differences and bank holidays. The interest rate on borrowed funds must be considered when computing the cost of trades across multiple markets. Investments in certain commodities, precious metals, may be subject to significant price volatility and often involve risks related to market fluctuations, liquidity constraints, geopolitical events, and changes in global economic conditions that could adversely affect their value. U.S. spot gold trading through IBLLC accounts is only available to legal residents of the United States that do not reside in Arizona, Montana, New Hampshire, and Rhode Island.